stop listening to the headline inflation number. And don't forget to subscribe to this channel and give me some thumbs up. So because this table tells a very different and far more dangerous story, what are we looking at is not inflation is coming down. It is inflation rotating, entrenching, and re-accelerating under the surface. As you know, inflation numbers came out a couple of days ago. So this table, the CPI table that you see, exposes the quiet truth. Core pressures are now easing. Service inflation is sticky, and energy is already turning back up. The Federal Reserve wants you focused on the average, right? It's under control. Markets want you focused on month-to-month noise because you're panicking. You're buying when they're buying and you're selling. You're off basically, right? But real inflation persistence show up inside the components. Take a look at what's inside the numbers, even though, quite frankly, we don't have all the numbers. Because of the recent government shutdown, you could see the tables are kind of missing. But real inflation persistent shows up inside the component, and that's exactly where this table becomes explosive. Look at the top line, right? Look at the top line. All item CPI, modest monthly gains. Nothing that screamed crisis, nothing that scares market yet. But headline CPI is not where inflation becomes permanent. Headline CPI is where inflation hides. Because headline CPI is dominated by volatile components, energy swing, food, and base effects. Central banks know this. That is why they obsess over core CPI and service CPI. And when you move your eyes down this table, you immediately see the problem. All item less food and energy, that is core CPI, right? That is a core CPI month after month after month, 0.2, 0.3, 0.3, 0.3, 0.2. This is not cooling. That is stability at an elevated level. And stable inflation at 0.25 to 0.3 monthly, that means 3% annually. Folks, we are basically getting used to inflation. And that's even before energy re-enters the picture. Energy, oil, oil is a big component and actually quite volatile, as you could imagine, right? So this is the inflation regime central bank fears the most. No deflation, no overeating, but persistent, embedded price pressure. Once inflation gets stuck here, rate cuts don't save you. They reignite it. Why? Well, if you cut rates, right, what you're doing, you're saying the economy is not growing fast enough. That's what you're saying. So therefore, I want entice people to borrow money at a cheap rate so they could buy and they could construct and they could build and they could restart the economy. So that's the reason why, you don't cut rates when there is inflation. Because if numbers are going up, by cutting rates, you're going to push up the inflation even higher. Once inflation gets stuck here, rate cuts don't save you. They reignite it. So service inflation, that's a real threat. Now, move further down. Services less energy services, right? This is a category Powell has called the key battlefield. And what do you see? Consistent monthly increases. No collapse, no relief. Shelter, still rising. Transportation services, still rising. Medical services, still rising. This is inflation driven by wages, labor shortages, demographic, insurance costs, and regulatory friction. Why is that? Well, listen, if things get more expensive, then obviously you want to get paid more money. If you get paid more money, then your job will charge more for the things that they're selling, therefore increasing inflation. That's why inflation begets more inflation. Then it becomes embedded. And you do not fix that with rate cuts. You do not fix that with supply chains. You don't fix that with wait and see. Once service inflation sticks, it feeds on itself. Remember that. No, wait, but why are we lowering the rates then? Well, we're lowering the rates because it helps the stock markets. Well, we're lowering the rates because we're saying, as you've seen recently, we have less job creation. Well, then how could we have, or why do prices going up? Right? Well, prices are going up because basically what you've seen with the situation with the tariffs. But it's not just the tariffs. Keep in mind, meat and coffee and all these things are not going up simply because of the tariffs. They would have gone up really. And how do you fix inflation? You fix inflation by raising rates and stop the government from spending money. Right? No more money for wars, no more money for anything, no more money for food stamps, right? You cut everything down, believe it or not. Well, we don't want that. Exactly. So why are we cutting rates? Well, because, the government wants lower rates because it helps the stock markets. And look what's been happening. And they're saying there is no inflation. And I'm saying, well, be careful. Inflation begets more inflation. Food prices are not going up just because of the tariffs. Do not believe that narratives. Meat prices are going up not because of the tariffs. There's been issues driving in the meat, the meat industries that's pushing prices higher. There's been lots of contamination and lots of issues. I'm not going to go into all the issues driving meat prices, but the point is not just tariffs. Let's talk about shelter, because this is where most inflation narrative collapses. Shelter continues to post steady monthly increases. Shelter, where you live. Rent pressure remains. Owner equivalent rent remains elevated. Household budgets remain compressed, and shelter is a slow-moving variable. When it turns late. When it accelerates for years. If shelter were truly rolling over, it would already have shown here, and it isn't. That alone should end the inflation is solved narrative. That means for you, if you got money in the stock market, be very careful. Be very afraid. Be afraid. Be very afraid. Remember that movie? Because what's going to happen is it's going to be 1977 all over again. I remember what happened then? We lower the rates because Nixon wanted lower rates. Arthur Burns, at that time, the chair of the Federal Reserve, said, okay, fine. And look what happened. Huge amount of inflation. And how do we fix inflation? Well, you're not going to like this, but we fix inflation by raising rates tremendously. And in fact, we put the economy in a recession. Now, here's where the table becomes dangerous. Energy showed volatility earlier. Some negative month, some relief. But look again, gasoline back to positive. Energy services up. Utility gas service still volatile, still elevated. Energy inflation never disappears. It pauses. And once energy turns higher while coal remains sticky, inflation reaccelerates fast. That's how inflation waves form. This table is the early warning system. You may not understand or want to hear or want to watch this table or be even bothered by it, but this is why I created this channel, to show you Black Swan. This is a black swan. Right? This is a fat tail. This is an event that's going to impact you, and you need to be aware of it. For a long time, falling goods prices mask inflation elsewhere. Used car, apparel, commodity. That relief is fading. Used cars shows renewed volatility. New vehicles are stabilizing. Apparel deflation is inconsistent. The deflation cushion is gone, which means service inflation now dominates, wage inflation now dominates, and structural inflation now dominates. And that is the inflation central banks cannot crush without breaking something, like the economy. This is where the Fed is trapped. This table explains the Fed's silence better than any speech. If they cut, service inflation reaccelerate. If they cut, shelter reflates. If they cut, energy amplifies. If they hold, financial stress builds. Debt service costs rise and growth slows unevenly. And if they hike, boom, they break something. This is not soft landing setup. This is policy. This is like policy deadlock. And markets are mispricing that reality. Markets are pricing faster disinflation, clean rate cuts, and contained service inflation. That is the reason why, for my Patreon channel members, I always provide advice and actual actionable decision pertaining to your portfolio. Because this table says the opposite. It says inflation is sticky, services dominate, energy is lurking, shelter refuses to fall, and that combination historically ends badly for both bonds and equities. I mean, this table is not boring by any means. It is a warning. Inflation is not gone. If you ignore it, let's put it this way, inflation isn't gone and it isn't entrenched either. And once markets realize it, repricing won't be gentle. If you understand this table, you're ahead of the curve. And if you ignore it, you're already too late.